Okay, all right. So let's make a start then for this report here. So the Canadian Employment Report. Uh, so first things first, what is it? So measures the change in new jobs being added to the economy, and that includes both full-time and part-time workers. That's what it is in its basic essence. And the unemployment report measures the number of unemployed as a percentage of the labor force. So we'll look through the figures and the triggers as well, what we had seen prior in the prior releases, and how much deviation we had seen, and how many pip moves we had seen on various different currency pairs. So how does it affect the Canadian dollar? So usually, in normal circumstances, we see an appreciation for the Canadian dollar when we get higher than expected or better than expected data from Canada, with the employment change first being the main figure, the main release. And to add on top of that, if we get a strong unemployment number, i.e., we get a lower unemployment figure than forecasted, then that would also add to the Canadian dollar's strength as well. And so that's in a nutshell, that's basically, to keep it simple, that's what we're expecting. Now, of course, it depends on the deviation of how far we are away, where the actual figure comes in compared to the forecast figure, and how strong of a movement we get to see. Bearing in mind, with the Canadian employment report that we get, usually that can get overshadowed by the non-farm payrolls report, because it happens the first Friday of every month. Sometimes with the Canadian release, as for today that we're seeing, that we get it on its own, and also historically back in October we had the release by itself as well. So usually it's paired up with the non-farm payrolls release, and it can get overshadowed. But when we do get strong figures, we do see a strong reaction to the Canadian dollar either way. Now, does that make sense to everyone so far? Does everyone understand that so far? Does anyone want me to repeat anything here? Remember, we will be sending out a recorded version of this here, of the webinar to you guys, for you to have for you to be able to see. Anyone have any questions so far? Are we all good? Amy, do you have any questions? Awili, SW, do you have any questions? Anyone else in the chat, do they have any questions about the report so far? Okay, Awili says no. Okay, good. Okay, so moving on to the next point then. So just some of the triggers that we've seen from Economist, and then we'll go through our own triggers of what we've seen from the market reactions. So according to Economists, we have the highest estimate of 325k, with the lowest estimate of minus 32.2k. So that's according to economists and their view there. With the unemployment rate, they see a high of 6.7% with a low of 5.8%. Of course, just bear in mind, looking at the what we can currently see for the forecast figure for Canadian employment change. So the current median estimate from Economist is 127.5k, with a prior of minus 201k. And for the unemployment rate, that's forecasted to come in at 6.2%, with a prior estimate of 6.5%. So overall, the data that economists are expecting to come out today is to show a better data, or stronger data, in February compared to the January report. So if we go back to our presentation here, we have a look at the slideshow. So other things to consider before we look at the market reactions of the prior releases that we had seen from Canada. So currently at the moment, of course, you've already had the rate hike from the Bank of Canada, citing, of course, inflation being quite high, it being the highest since 1991, 5.1%. And also what we had mentioned beforehand within the previous Bank of Canada meeting where we got another hike to 0.75%, with GDP being better than expected, and the bank had predicted 6.7% to finish in the fourth quarter of 2021. Excuse me, the fourth quarter finished at 6.7% in 2021, whereas the Bank of Canada was expecting the economy in the fourth quarter to come in at 5.8%. So, first of all, the reason why we're going through these points here of inflation and GDP being better than expected and being quite strong is that current sentiment adds to the bullish sentiment for the Canadian dollar. Of course, the better that the Canadian economy does, the more appreciation we would see from the Canadian dollar, and where we could potentially see the Bank of Canada continuing their rate hike path if that continuation of strong economic growth continues. Of course, bearing in mind, if for the next report for inflation comes in higher, reminder, there were some comments from Bank of Canada's Governor Macklem talking about if the economy continues to do much better than expected and inflation comes in higher, then there could be a possibility of a 50 basis point rate hike at some point down the line. So that in itself, whenever a rate hike occurs for an economy in an expansionary phase, which is what we can currently see for the Canadian economy, where it is at the moment, then that would be, again, it's a positive note, or we would see an appreciation in that currency. And a different environment, let's say, okay, so whoever's put that question in the chat, I'm sorry, we do not have that here. Going back to the presentation, apologies for anyone who's joining in to actually get some preparation for macro ace. Seems like we could never get away from that. Apologies again. So going back to where we were, if in an economic expansion phase, which we're currently seeing in the Canadian economy, we get rate hikes, that's a positive for the Canadian dollar. Whereas on the flip side, if the economy is shown to be in a state where inflation is too high and interest rates aren't helping to bring down the level of inflation, and we're actually getting a thing where we see stagflation, i.e., unemployment is high and inflation is high, and rate hikes are not able to combat that, then that could potentially have the effect where we see a depreciation in the value of the currency, as it's proving that the interest rate or the tool of using just interest rates isn't having a positive effect on the Canadian dollar, and things are getting too out of hand. Now, the only way to kind of control that would be where if we look back to the US, back in the oil crisis that we had in the late 70s to early 80s, where interest rates were really high. I think they'd reached about 18% at one point, due to inflation being quite high as well. So only after a large amount of increases. So only after, if the bank takes extreme measures where they hike rates by a lot to try and control inflation, or they take other measures to if they do have any asset purchases that they have, or any QE, quantitative easing, if they remove that, then you could see potential reversal of that negative effect from the scenario of stagflation. So going back to the release, of course, now the current sentiment with a strong economy, with high or better than expected employment figures, we could see that continuation of a positive reaction from the Canadian dollar, as we've seen in the past. And as I said, we'll have a quick look at the prior market reactions, bearing in mind there has been that rate hike that has happened. Apologies, it went to 0.50%, not 0.75. That's a crazy jump for the first time that the Bank of Canada decides to raise rates. So even with the first hike that's happened now from the Bank of Canada this year, um, we're still seeing that positive reaction from the markets. Bearing in mind with the prior non-farm payrolls release we had coinciding with the Canadian data again, that data was negative, so we had seen depreciation from the Canadian dollar. So going to the next point here, other bits of sentiment. So as I mentioned, Macklem, when asked what he would have to do or what he would have to see for a 50 basis point rate hike, didn't clarify in further detail, but he did mention that they were willing to be more forceful if they believe it is necessary. Again, thinking about GDP, but the main thing that every other central bank is focusing on is inflation data, right? If inflation overshoots or continues to break or continues to be at record highs, then that will lead to a further potential tightening from the Federal Reserve, and that could see potential we could see a further appreciation for the Canadian dollar, where Canadian stocks see a depreciation from those more aggressive moves. Now, oil and the current Ukraine-Russia crisis that we're seeing at the moment. This is something that maybe not a lot of traders think of, but of course, if we consider Canada's economy and how it runs and what it exports the most, it's a commodities-based economy, i.e., a lot of the exports is the 17.7% of the exports is made up of providing mineral fuels, including oil. Right, this is 2021 data that we can see. Vehicles make up 11.9%. And then you also have precious metals, so that's including gold as well, makes up about 5.9% of their exports. So when we had seen the risk-off reaction from the markets, where WTI crude had spiked and had seen a huge appreciation, also with gold as well, and the Dixie had taken a tumble, the Canadian dollar had seen that appreciation. You've also got to remember the other commodity-based currencies that trade in dollars. So you've got the New Zealand dollar and the Aussie dollar too. Those other two commodity-based currencies had also seen that appreciation as well. This goes back to Macklem's point of view here, saying that if it is maintained that $110 per barrel oil price occurs, then it will add another percentage point to the inflation rate. So that's key for how the Canadian dollar fares. Of course, with more inflation, the higher that the value goes for the currency. Of course, if it gets way out of hand, then that's a different story, and that's a different scenario we'll cover in a different webinar. But at the moment, with high oil prices and what we had seen from the Ukraine-Russia conflict and how it affected the markets with an overall risk-off reaction, this point here, if we do continue to see, let's say, if we see some negative news that's going to boost the price of crude oil, then we could see a stronger Canadian dollar. So why am I talking about that for the release? And that depends on how much the Canadian dollar has moved, let's say, for that day. If we've had let's say we've had really negative news from the Ukraine-Russia conflict, or where, let's say, that the conflict, where the current discussions that Ukraine and Russia are holding at the moment, they turn sour and there's a risk of reaction again. What that could mean for, let's say, for the day, for the Canadian dollar, if the Canadian dollar sees a huge amount of appreciation off of the Dixie seeing a decline and crude oil prices increasing, then for the release itself, it may mean we might not see as strong as a reaction for that release. That is a possibility. And just to note, going back to non-farm payrolls, if you were there in the webinar that I held for that event, when we had uh, where we had some, it was some negative news for Ukraine and Russia at that point, and we had seen, even though all the figures for non-farm payrolls came in better than expected, we didn't meet our 300k deviation for the main or the headline figure itself. Regardless of that, we had seen a small pop up on the Dixie, and then we had seen the markets continue. We had seen the Dixie continue its. Then we had seen the Dixie move towards the downside, and see a reversal of its initial strengthening from the day. Whereas the S&P 500 had seen an initial quick. It was like a blip. We had seen a small decline, and then a move back, and then a move towards the upside, where the S&P 500 continued to move on for the rest towards the upside for the rest of the day. So for the Canadian dollar, could we see a similar reaction to the data that we're expecting today? Maybe. Again, we did, as said, we did have some breaking news earlier in the day that you had Putin saying that discussions with Ukraine have taken a positive turn, or that there are positive shifts within the talks, which the markets, if we're just going back to, if we have a little look here, if I bring it up. Here we go. So not too long ago as well. So here we go. So we've got the Dixie, we've got WTI crude oil, gold, and the S&P 500. So this risk-on reaction, where we have seen some really positive news coming from those discussions, or discussions that are being held, has seen a very strong movement. So we could potentially see where the Canadian dollar might not see too much of a reaction if we've had this sentiment take over the market reaction overall for the day. But that doesn't mean that there is a possibility that we could, with strong figures that could come through for Canada, that doesn't mean that we won't get a reaction. So with sentiment driving the market at the moment, from what we've seen today, is a bit of a, we've got to be quite cautious of what we do from what we can see, considering with the last non-farm payrolls release, which typically during a hectic or volatile market, it usually sees a reaction. I'm just kind of cautious. Does anyone have any questions so far? Have I bamboozled you with anything? Is there anything you want me to go over? Any questions so far? Or is there anything you want me to cover off again? Okay. Right. So how many minutes viable for reaction? So from what I take it is, how many minutes does the initial reaction hold for? Is that what you mean? That's something that we're going to have a look at in the market reaction, which will be the next thing that I currently want to have a little look at. So let's take a look at that now. from the prior market reaction. So this is Feb 4th data that we had. We go to the Canadian employment change. Okay, so Feb 4th. Well, actually, we are looking at it on here on the playback. So perfect timing from what I've seen from the past. So if I go back to 0829 2950, about 10 seconds before the release. Bearing in mind, this is when we had non-farm payrolls as well at the same time on the Feb 4th with the Canadian employment data. We go here. There we go. Okay, so that's the first minute there. So Feb 4th, CAD JPY, and also currently what have opened so far at the moment with the Euro CAD initially. So Euro CAD did see some strengthening there. CAD JPY had seen a bit more of a whipsaw. We'll look at the USD CAD, which has seen a stronger reaction compared to the other currency pairs that we're currently looking at now, and we'll go through what the deviation was on there. If I bring that up here to the side, and that'll probably be there. We go. Okay, let me bring up a USD CAD. Okay, all right. So I think I'm just going to close TechStrike for now. So you should still, can you guys see the USD CAD, Euro CAD, and CAD JPY? Can we see it all clearly? Okay. So we're still in the first minute here, but if we go to the deviations, and we'll actually all play at the same time. So with the deviations that we had seen, so remember it's the forecast figure, or it's the actual figure minus the median survey or the forecast figure, and that's the total difference is what we get, and that's what we look out uh, for any future strong reactions. So with February 4th, we had seen about a 90k difference on the employment change figure, and the reaction that we received from the US dollar to the Canadian dollar, we had seen about 34 pips towards the upside. So that's on the first candle. Bearing in mind that's including the start of the candle to the top of the wick of the candle that we're looking at here. So that's the USD CAD. On the CAD JPY, we had seen the initial move towards the downside by about 8 pips as well. But if we have a quick measure here, so it's quite a quick reaction for what we had seen. The reason why I look at the USD CAD more compared to the other ones, I think is for this main reason here. So if we have a look here, so CAD JPY overall. It's CAD JPY on that initial candle. So as said, 8 pips towards the downside first was what we had seen, and then we had seen that move back towards the upside at 7 pips towards the upside. That's what it finished on the first candle. So the stronger reaction happened on the USD CAD of what we had seen, whereas on the CAD JPY we had seen the reaction where it went in the direction that we had thought it'd go into, where if there was a weaker figure that had come through, then it would be negative for the Canadian dollar. But then we'd seen that reversal on the CAD JPY. So whereas the USD CAD had held itself a bit more. So this is now 2 minutes into the release. So as you can see with the CAD JPY, it's seen that first red candle forming after that minute and starting to, where it looks as though it wants to move back towards the downside there, whereas the USD CAD still, after about 2 minutes, still seeing that move towards the upside. Now, how many minutes is the reaction viable for? That's the difficult thing to estimate. Of course, it's also going to depend on the sentiment too. So with currently today, with positive news from Russia, from the Russia-Ukraine talks, if we do get a really strong figure, we could see the continuation, or we could see a good strong reaction from the Canadian dollar, be it negative or positive, where it lasts for a longer time period. But if we see where the deviation isn't that much, and what we've seen in the past, where if there's about a 20k difference, then where the figure actually comes in line with expectation or near enough towards the forecast, we'll get that initial pop or drop, but then we'll see. But then what it would mean from what we've seen in the past, that it could mean that that initial pop or drop could reverse on itself quite quickly. But that's mainly from what we've seen. So for February 4th, as said, the figures were really good, i.e., we had a strong deviation for the Canadian employment change. So hence why we can see the USD CAD compared to what we can see here on the CAD JPY, seeing a stronger reaction on the USD CAD here. So still 3 minutes in, and we're still seeing that we're still seeing that move towards the upside on the USD CAD. EuroCAD, if we have a look here, deviation wise as well. So EuroCAD, if we have a look here, so we had seen about 19 pip move towards the upside off of that figure that came in worse than expected. So again, that was about 90k deviation from the actual figure, where we had seen a strong reaction. Does that kind of answer your question, Awili? So the bigger the deviation, the stronger the reaction is going to be. And from what we've seen last time, so nearly 5 minutes into this here, and we're still seeing the Canadian dollar seeing a move towards the upside. Precise? Is that precise in a good way? Or is that precise as in, it's like, it needs to be more precise? Or is that ching? That's good. Okay, so about 2 minutes away now from the release. So as said, we're looking for about from what we're looking for about is about a 90k deviation from what we've seen in the past, to be able to see a strong reaction from the Canadian dollar. But as shown in the past, so there's EuroCAD had seen a decent move towards the upside. The USD CAD had seen a decent move towards the upside as well, whereas CAD JPY had seen that initial dip and then instant reversal on that same candle. We go back to, so we got a minute now, so what I'll do is I'll stop that there, and let's have a look at the release. So again, as said, at least 90k deviation of what we're looking for from the last report of what we had seen for a strong market move. So if I bring that back there and let me go to the FJ site, let's turn on the sound just for this. Okay, 12 seconds, 10 seconds ago. Okay, and here we go. Okay, much better than expected at 336.6k, which is higher than the forecast of 127.5k. Okay, let's keep an eye on the market reactions. What we see here. Whoops, and that's all connected. Ooh, okay, what's going on here? Whoa, that isn't. Okay, that decided to freeze. I'll bring that up. Apologies for that. Okay, there we go. Ta-da! Okay, so much better than expected figures. I'm gonna have to reset these. Actually, that is a shame. Okay, all right. So EuroCAD's down, USD CAD is down as well. If we look at CAD JPY, let's bring that up as well. There we go. So CAD sings strengthening there off the back of that release. I hope everyone kind of caught the reaction. I apologize if this chart had frozen. Apologies for that technical issue on our side. But as we had expected, the the unemployment rate came in much lower than expected as well, 5.5%, right, with a forecast of 6.2%. So about 0.7% deviation from the forecast. That's a really strong figure there. So what I'm seeing overall, entwined with the employment data coming in much better than expected, and also the unemployment rate coming in way better than expected. This is what's causing this strong move from the Canadian dollar, what we can see so far. So if we look at the pips here, if we go to the USD CAD, how much did that move down by? Okay, see. So it looks to be about 29 pips so far. Yeah, about 30 pips towards the downside on USD CAD. If we look at the Euro CAD, have a little look. So from bottom, so what I'm doing is I'm going from, if you can't see this clearly, I'm going from the bottom of the candle to the wick. Okay, I think I can see that there. It's about 26 pips. That's what I can see on the Euro CAD. 26 and a half, about 30 there, about 26 there. So at the moment, USD CAD is seeing a stronger reaction. Let's have a look at the CAD JPY. Look here. Okay, so it's seen about 19 pips, what I can see towards the upside of that initial reaction. So overall, so the USD CAD seeing the stronger reaction or the bigger reaction from the more positive Canadian dollar. Bearing in mind, this is Canadian dollar by its this is the Canadian employment report by itself. So you don't have the non-farm payrolls kind of overshadowing. So still, even with that there though, we're still seeing deviation. Let's put in the deviations here. So that's about, got that here. Let's see what we get. Let's see what we got. So it's about 127. Okay, so deviation wise for the employment change or the figure itself, we'd seen about 209k deviation from the forecast figure between the forecast and actual figure. And the initial move towards the downside on USD CAD, as said, about 30 pips towards the downside. Euro CAD seen about 26 or 27 pips towards the downside. CAD JPY seen about 19 pips towards the upside. So overall, still seeing the USD CAD as seeing the slightly stronger reaction compared to the other currency pairs that we've noted. If we keep an eye on GBP CAD too, because I also want to be conscious of that to have it as a measure. Okay, let's hopefully see. I think if we're seeing the USD CAD seeing a stronger reaction compared to these other currencies, I don't see GBP CAD having as strong as reaction as USD CAD. Let's see. Oh wow, okay. I may be wrong. I may be wrong indeed. Right. So if I be actually, let me just move that other way so it's easier to see. It's about 33 pips towards the downside on GBP CAD on that release there. So again, as said, going from the bottom of that candle to the top of the wick, or to the lowest point of that wick. So from what we can see, so in the past, what we had seen from GBP CAD with this data, it's we had usually seen about 20 pip move either way, but considering we're seeing from this really strong data that's come in from Canada, as said, of over 200k deviation and a really good unemployment figure coming in, that could be factoring into a better than a really good move from GBP CAD. But overall, the strongest mover so far from what we've seen has been GBP CAD. Then we have the US Canadian dollar. Then we go to the I said Euro Canadian dollar, and then we have CAD JPY as the one which had seen the least movement from the release that we had so far. Also looking at other areas as well, not excluding the other releases. So Canadian participation rate also better than expected as well, and the average hourly earnings seeing a good tick up there. So wages are increasing. Employment was strong for the month of February, and the unemployment rate was even better this month. So with the first rate hike already happened, does this mean that the central bank or the Bank of Canada is likely to raise the interest rate by 50 basis points? That's yet to be seen. We've got to factor in where we get inflation coming in for our next inflation read, and if we have a little double check of that here, when that next would be, when that would be next. Okay, so the next one is also happening on the same day that we get the Fed interest rate decision. So next week, that we get that data. So that'll be the Wednesday. Now, for the not seeing any forecast from economists as of yet, but we'll keep an eye on what economists are looking for. Again, just to go back to the PowerPoint. Whoops. Just go back to the PowerPoint here. Go back up. So, if with the inflation rate being the highest since 1991 at 5.1%, I would see that if we get any stronger inflation reads, alongside with any better than expected GDP figures, coinciding with a strong employment report that we've just seen today, again, it's down to the Federal Reserve excuse me, not Federal Reserve, not Canada, as it will be down to the Bank of Canada. So that's more of a wait and see. It'd be good to see the reactions from economists for this release and what the markets are expecting for the rate decision ahead. We don't usually get a lot of commentary coming through in regards to where they expect the bank rates to go after the employment report is released. That's something that kind of takes a little while to come through. But if we look at just some of the past comments of the current elevated risk that we're seeing with the Russia-Ukraine situation, with elevated, so according to Scotiabank, they said that with elevated volatility and heightened risk aversion remain clear impediments to the Canadian dollar, benefiting more obviously from the gains in commodity prices at the moment. So again, if we see this continuation of the Russia conflict having a stronger effect on commodities, and the Bank of Canada, of course, central banks don't control energy prices. They can, of course, only control interest rates and the money flow within the economy. Um, if that passes on to consumers, uh, and we see higher inflation reads or inflation prints, could mean that, or really strong reads, it could mean that the Bank of Canada might step in and go for an even higher rate hike. But at the moment, it's more of a wait and see. So again, strong employment report that we had come through, seeing the CAD, the Canadian dollar strengthen overall. It was GBP CAD that moved the most on that release that we had seen, and then it was the USD CAD that had seen the second strongest reaction. Okay, does anyone have any questions before I end the stream here, or end the webinar here? Any questions? Are we all good? Did you guys find that useful? I'm always looking for feedback on the on the on the reports and the webinars that I do. Link for bank orders, please, says Awili. Now that is something that we'll have a little. We can have a little search and have a little dig in. I can't get that right now for you, but what I can do for you, if you enjoyed this seminar, excuse me, not seminar, if you enjoyed this webinar that we had created, then what we can do is give you the link to sign up to our next meeting and join our mailing list. So what we'll do, if everyone just wants to type, or just to me, if you want to type your email address, and then we can go ahead, and then the webinar is powerful. The previous was powerful. Hey, appreciate that. Thank you very much, Awili. That's very good. Good to hear. But yes, if you do want an email, if you do want to be added to the mailing list for the next Macro Ace event, you can just email tony@financialjuice.com. I'm currently typing that as I speak for you here. financialjuice.com. Okay. So if you email here saying that you would like to be part of the mailing list, we're going to get the mailing list sorted so you can actually use that rather than having to, you can actually click on that for future people that will be listening in. You can click that link. But for now, if you wanted to email Tony at Financial Juice, and we can get you set up on the mailing list so you can stay up to date with what the next economic release is going to be. Of course, next Wednesday is the FOMC meeting minutes, where there is expected to be a 25 basis point hike. And as said, we do have the Canadian inflation data on that day at the beginning of the day as well. So take note of that email. Just email that you like to sign up to Macro Aces email list, and then you guys can stay up to date. But for now, if we don't have any more questions, then I will leave you guys to enjoy the rest of your day, and I will now go to the gym. I've got to stay healthy. I had some nice eggs and rashes this morning. So get the power in. Get the body pumping. All right, you guys take care. I will see you next time. No worries, Amy. Thank you for joining. And again, if you want, of course, as I said, if you want to stay up to date, just just hit my mic. Just send an email to tinyfinancialjuice.com, as in the chat there. And then we'll go from there. Actually, if I put that, I think it's just me. Host and pan list. There we go. There we go. That's over. Now everyone should be able to see my email. That should make it easier. Okay. All right. If you guys have taken note of that email, I will see you next time. Goodbye.